no matter where you're at in the stage of your company, we have to be able to create your funding plan. Here's one of the first steps of the frameworks that I want to be able to teach. The better, if you're just starting out and you haven't created your LLC, right? You have the frameworks. A lot of that information here is in Rad's community. But if you're a startup in less than 2 years, if you're established for more than 2 years, then the question here is, do you have cash flow, or are you just starting out and you need the capital to be able to make more money from that? So one of the first things that you're going to see me talk about and throughout my journey here with you guys is know the rules of the game before you play, right? Understanding the banking formulas, the bank data points, and understanding how that relates to you. You can incorporate this within the 4 pillars. Number 1, optimizing credit to be an 800, setting up your company like a Fortune 500 credit business. You're building your business credit to get approvals and organizing your financials to be bank ready. One of the best advice is, at the end, learn and understand this between every bank that we work with. So once you understand your 4 pillars, you want to compare that to the types of loans that you want to qualify for, right? What are the bank data points? What credit bureaus do they pull? What are the financial requirements? And when you take that, you want to be a lender match between the banks. And then here's like a little bit of an example of what we do actually internally within our organization, is that you want to itemize, number 1, who's the first bank that I'm going to go to? Who's the second one, third one, fourth one? So again, one of the best things here is about knowing what your plan is, right? It doesn't matter if you're looking for 50,000, 100,000, 250, $500,000. You want to reverse engineer your goals, because the clearer we are about what we want, the faster it is for us to get there. And so when you put this plan in, you're able to see how fast you can obtain it. And as we all know, we always want to start with business first, and then we go into personal if that's something of your, depending of course on this stage. But if you're a startup, it's very recommended to do a little bit of both. But if you go to your business lines, your credit cards, your approvals, you do your leverage factor, right? If you want to get 5, 10 approvals, and you go in and you do an inquiry wipe, and then you can start on your personal. So there's a sequence that I do between myself of how I'm able to really get the bigger amounts of lines. So if you look, if you're a startup or you're just starting out, or let's just say you have baby credit. So one of the first things you want to do is you have to have a minimum amounts of trade lines that count. The strength of your personal credit is being used to help leverage your business credit. So you should have at least 3 to 5, revolving trade lines. Let's just say you start building it up, you get your $25,000 in limits. You have 1 to 2 unsecured installment at minimum, right? So if you have $50,000 limits right there, in between of you getting your first step, remove the inquiries. Let this trade season a minimum of 1 to 2 years. Right? The magic number in finance is 2 years. But let's just say now you're ready to go to step 2. You'll be able to get your 3 to 5, accounts, 25,000, 1 to 2,000, 1 to 2 unsecured, installment loans. Get your 50,000 from there, right? So again, you always want to be removing your inquiries between each session. If they don't report on your personal credit, there's a little small window that you can go in and do that. So now you have enough capital to reinvest back into your company, and you're stimulating some cash flow by looking at your business bank statements, your tax returns, depending on the age of your business. So once you've exhausted your business credit at that point, and you're like, look, I've exhausted it, I got 5, 10, 15 approvals, whatever that looks like, preserve your credit. Then you want to go back and re-up on your personal. So your 25,000, you ask for credit limit increases. Now that sets the new bar for your highest revolving limits. Then you go and get 2, 3, 4, another 1 or 2 installment loans, where now you have $100,000 limits. So you went from your 25 to 50, 50 to 100. Now you're looking like really pretty on paper. So when an underwriter looks at you, they're going to say this person has the experience of handling larger amounts of money. And so the combination of your personal credit, business credit, and your financials, when you have some cash flow, that's where you can start going into the bigger amounts of money with the $500,000 plus. All right? Does that make sense, guys? So you always want to be playing personal, max out business, go back, strengthen personal, max out more business. All right, so fun and plays for some startups, right? And in this category of your business, you want to rely really heavily on your personal credit. Again, you have to be around a minimum of a 700 credit score. If you haven't already, recommended build up your business, credit, your Duns & Bradstreet, your Experian, your Equifaxes. at that point. It's very, very simple, right? Especially you want to do the corporate compliance section first, where you get your business address, phone number, email, website, low risk industry, your NAICS code. If you have a high risk industry right now, of course, real estate, financial services, anything investments is a hard pass between any lender out there. Change the company, change the name, make sure that you update the NAICS code from that. And then you want to look at your financials. Okay, what are the area of strengths that you can play with? Either your personal tax returns. There are no doc programs for startups as well. If you have some cash flow and you can leverage the business bank statements, that's going to be good. But again, you want to look at what are the areas of strength, and then what can I qualify for based upon my current profile right now? What can I get to take the next step of my business? Of course, I'm gonna go through this really quickly. Nothing that hasn't been seen on the Rat Show, before. But I guess your personal and business credit cards, your 25 to 150,000 when you include your leverage factor, your 0% cars. Startups are okay, streamlined, no docs. Go from there. Make sure you optimize your credit at 700.
And that's a really easy thing. Go back for a second. That's a really easy thing that people can do by themselves, isn't it, Anthony? This is not something that they really need a funding company for. It's the no doc loans, it's the bank statement loans, it's these things that they really need help with. But getting business credit cards at 0% is really easy, isn't it, Anthony?
Oh yeah, it definitely is. There is an art behind what we do with the credit card stacking. I mean, there's
right. Can you kind of talk about credit card stacking a little bit so people understand what that actually looks like and some complexity, what's bullshit and what's real in credit card stacking? Because we have a lot of these gurus out there that don't even know how to read a credit report. That's a funding company.
Yeah, it's so true too.
So
Look,
can you kind of talk about the real and the fake with credit card stacking? What's real and what's bullshit out there being regurgitated?
I mean, coming back to the funding plan, right? If you look at, you shouldn't have more than about 4 to 5, inquiries per bureau. And so looking at who are all the lenders that are going to be able to pull on a TransUnion, on Equifax and Experian. And then with the story that you can do you want to work with a relationship banker, or do you want to work on online submissions? In my opinion, relationship bankers have a stronger presence to increase your loan amounts and your approvals. And I'm going to show you an example of what I mean by that, a little bit later on. So again, right, you want speed or do you want amounts, right? These are all certain things depending on your current circumstance of what you're looking for. The longer game, it's going to take about 1 to 2, 3 weeks sometimes with a relationship banker. And so it depends on that company, and knowing and understanding, hey, which one of these banks are very inquiry sensitive and which ones are a little more relaxed.
The devil's in the details. The devil's are in the details.
So that's a little bit of the art behind what we do on this element. There's a funding order, a sequence. It's like any type of recipe. You want to make sure that you follow the recipe. So if you're going to bake that cake, that it's not going to go ahead and fall and crumble if you do it incorrectly. So no matter what product or loan type that you work with, you better understand the sequences, what the data points are, and going from there.
Let me ask you this too, is, there's rumors in the game, and I know the answer to this, but I'd like you to answer this, that some relationship managers are actually compensated by funding companies or by individuals that do funding to push through applications on the back end. Is that false or is that true? So for example, if somebody has a Chase relationship manager, I know people in the game
enough, again, none of that information is public, right? It's right. They're not legally supposed to get any type of compensation. Again, people are greedy.
What they do.
You slip something.
What they do. Money talks.
Or a briefcase full of bags. I mean, again, if you understand that, every bank has different tiers, right? Will the banker have an influence on the underwriter, or is it centralized between a different department where the banker is just really a paper pusher? And
let's talk about this.
I actually do know somebody that told me that they are slipping their Chase banker. Funny enough, you say that.
Of course they are. So here's one of the things I want to say. There's a Chase banking relationship manager that I know, good guy out in California. And him and I talked about stuff and how the process works. Basically, All people need to do when it comes to Chase is set up a Chase business checking account and have money in there and be putting deposits in there. And then they go ahead and they take that business checking account and they run, a DocuSign into underwriting. And then underwriting comes back and says what they're approved for, what they're not approved for. And then the banking relationship manager can go back to underwriting and say, hey, can we relook at these different things right here, X, Y, and Z, because this is the case here. And they can kind of frame that story, which you frame to the business relationship manager, which then the business relationship manager brings to underwriting. So guys, you guys can get your own business relationship managers, but it takes time to build these relationships and it takes time out of your day to go get that. And time is money. So these are 1000% something that you can do yourself. But with that being said, there is power in working with somebody that actually has established relationships to move this thing past the finish line in a shorter amount of time. But that's the bottom line, guys. To be able to get business Chase credit cards, you don't need Anthony Vanaki. You don't need all these other funding companies, guys. You can just literally go open a business Chase account and go meet the relationship manager and start your process, guys. That's it. The underwriting is there's more there because when you're dealing with stuff online, you're dealing with more fraud, risk, litigation. So you're dealing with people that are submitting applications online. There's more measures there to be catching fraudulent applications or people putting inaccurate information where you're working with the relationship manager. There's less of that because there's actually a process between humans and not technology. Is that correct, Anthony?
Yeah, 100%.
This is honestly, Anthony, what they all focus on. They all run ads to the 0% business Chase cards or the Elon Financial or the US Bank. This is stuff everybody can get themselves, guys, right? If you don't want to do it, that's one thing. If you don't feel like you can get the top limits, that's another thing. But this is something that you can get yourself. Honestly, what business funding, guys, is an agency. Social media marketing agency, credit repair agency, business funding agency. There's nothing wrong with an agency and there's nothing wrong with people making money for their time. The problem comes is when you overpromise and you underdeliver and you shit the bed and you make people feel like scum and you don't do good business ethics. That's where 90% of agencies suck. Social media marketing agency, it's all agencies. They promise you a result, they shit the bed, they don't deliver. That's why I love that you call your company Deliver Capital, because you actually deliver the capital, okay? You actually remove the inquiries, right? And you actually scale the loans, right? So everything that you actually say, you actually do, right? It just gets messy because, bro, it's a very, if you were both being honest here, it's a very shady business that you're in. It's a very shady, greedy, greed-filled business where people only care about numbers and they hide behind this blanket of integrity when nothing's integral about them whatsoever.
Yeah, and a little bit later on, I'm going to share with you guys how to craft a story for the banker. I'll give you some examples that you can then replicate for yourselves. All right, so unsecured personal loans. Essentially, in every loan over here can be 25 to 250,000. Your 7 years, 8% and above. Right, very very common. You guys understand the personal, but I love actually helping clients and startups because if we've exhausted everything on the business side, then we can't get more. But if you need that extra 100,000, 50,000, then a personal loan might be the route to go for that. Streamlined business startup loans, where I've actually been seeing a lot of trend recently here that some of these major and regional banks are opening up their doors for startups anywhere from $25,000 to $50,000 on a BLOC.
Nice.
A lot of them will be reviewing your personal income. Some are basing on the strength of your personal credit. And of course, you get your $25,000 to $30,000, $50,000 business line of credit, and then you can add another credit card in addition. So it could be another 20, 25,000. Of course, the strength of your personal credit is going to really judge from the bank of your character and what that looks like.
Nice.
So looking at your business cash flow, major banks will look about 10% of your annual gross sales. So if you have your 3 months, you're doing 25,000 a month. You do that times that by 3 is 300,000 projected of your annual gross. That's going to be about a $30,000 loan amount from that. Take that, go to 2, 3, 4, 5 different banks. There you go. There's a good $150,000 you can get from there. All right, so startup lending options. I'm not sure if you guys have ever heard of the the ROBS plan for any type of tapping into your retirement and IRAs and 401ks by any chance. So essentially very similar to like a self-directed, where if you have your retirement account and you're able to create a C corp, put that into a company, and then essentially with the whole structure of it, you can use your retirement plan tax-free to start and jumpstart your business here. This is actually very popular in the franchise world, as I was working very heavily with the franchisors, becoming their funding department in my previous years. So very popular. If you haven't already, if you don't want to be paying taxes on that, this might be a good plan. Or self-directed, if you want to invest in your real estate or different assets or in different companies, self-directed could be a great decision there as well. All right, so funding plays for established business. Some of the foundations here. Look, at this stage, you've been more than 2 years in business. You should have some revenue. Your personal credit, of course, is always going to be a factor in its element, but you have a little more cushion to work by compensating factors. So what do I mean? What do I mean by that? By this point, you should have some business credit, your corporate compliance, your website presence, local listings, all that stuff should be there. And if you have your bank statements, tax returns, looking at the whole entire picture, where in the banking terms it's called compensating factors, which is kind of like if you're looking at a tipping scale, where if one area of your category, your 4 pillars, isn't as strong, but you have stronger revenue, right? And well, the bank look at that and say, look, I want the business, I want the cash that he's depositing, so he want to mix his big relationship banking, to move his banking over there. So really creating that story of looking at, hey, what are the strengths of this person's profile, and why is it important for this person to go to this banks, right? You want to have a solid explanation for the weaknesses and really emphasize on the strengths. You also want to, at that point, if you have any weaknesses, like if it's, some credit challenges, late collections, or some sort, if it's paid or not paid. And again, the whole Silicon Valley Bank collapse and the Signature Bank collapse really made the game a little bit stricter as far as their credit profile. But there are certain lenders that maybe a Chase isn't the best bank because you may have some weaknesses in your file, and they're very strict. Bank of America, very similar. But there's a whole bunch of other regional banks, even other major banks, that have a little more leeway on those approvals. So again, those are some of the little things that really make a difference on your approvals over here. Our business loans, of course, your streamlined, programs, 3 months of business bank statements. There's a lot of no docs as well, from 50,000, sometimes even at 100. But right now, honestly, what I'm seeing is that unless you have some very strong business credit and some established experience on the business side, and you have strong personal credit, an underwriter can always ask for supporting documents, right? Give me a tax return or give me a business bank statements, even though, the sentiment of the world of what you see on YouTube and stuff can be different based upon your profile. And that's kind of a little bit of the art behind what we do over here as well. But love my streamlined programs. Your credit requirements are going to be key. I'm going to get into personal credit a little bit later on as well. Your business credit cards, you guys are very familiar with that. One thing I will say is if you're looking at your banks and you're looking on their websites, there's certain keywords that you want to look for, streamline, express, fast application, instant decision. So these are the programs that we want to extract because, they don't really advertise this online. So our strategy is to be able to look at, hey, how many of these unsecured lines can we find? Anywhere from 50 to 150,000. I like to be qualifying more for business lines of credits because you only pay for what you use. And so if I can get a quick approval with bank statements or a lower amount, right, of either a no doc, that might be a little bit of our strategy going in. Because time is real. I mean, time is money. But let's be real, right? It's precious, and a lot of times we don't have it. One of the biggest pain points I face in my business. Actually, what do you guys think? One of the biggest pain points, a company like ours, that we are full service, we handle everything from A to Z for you. What do you think one of the biggest pain points are for us? And if you can guess this, whoever the first person is, I'll do a free one-on-one strategy, a deep dive session with you. No, it's not time. For dealing with my clients, what do you think is one of the number one pain points that I face?
I know what it is, but I can't tell. Nick said compliance. Documents also.
It's documents.
Yeah, man.
Documents.
You gotta submit your damn documents, bro.
And that's not fair, Teresa, because you've been with me for a long time. So document collection, guys, is literally one of the number one challenges that we face in my industry, right? As I do full underwriting, do the full review. We'd like to see the whole entire picture, be able to really pinpoint the best decisions for you guys. But yes, all right. So funding strategies, moving forward here. So 3 months of your business bank statements. Now, again, what I'm teaching you is about know the rules of the game before you play, right? You have a much better chance of winning if you understand it. So looking at your streamlined business loans as an underwriter, you want to look very closely at your statements. So here are some things to look for. Number one is the number of deposits, right? The difference between your revenue, your income deposits versus loan deposits versus transfers. So transferring from your own accounts back and forth that may inflate the number of total deposits doesn't count as far as underwriting looks like. So those are all certain things that they're going to look at. Where's the money coming from? The frequency of deposits and from whom. So for an example, if you're in a business and you're only getting revenue from one company, one source, a bank will deny you because of that reason by itself. You might have 50 to 100, $200,000 a month. But the theory behind that is that what happens if you lose that one client? We give you this large amount of a business loan. You're going to go out of business. So have a minimum anywhere from 5, 6 different sources of deposits coming through. Something that these banks look for. Look at your beginning balance and your ending balance. So a underwriter is going to look at, hey, how much cash flow is this person having? And a little bit of a little small trick that I coach on my clients is like, hey, if you have to pay a vendor on the first or the second, and you're trying to inflate and make sure that your business bank statements are looking as strong as possible, see if you can then pay them on the first or the second and leave your ending balance a little bit stronger than versus having to pay on the 31st or the 30th. Does that make sense? And so again, perception can be a key if you're at that stage of your business. And then you also look at your average ledger. So if you have some capital, or just you have a business credit card that you want to liquidate and have that sit in the bank because you're going for a business streamlined business bank statement play, right? 3 months of, then make sure that you're looking at your bank statements as strong as possible before you go. Increases your chances of an approval and higher amounts of money. Hopefully that makes sense. And no NSS, right? Your non-sufficient funds. If you're going through this roller coaster of swings and you have a 1, 2, 3, typically about 1 or 2 within a short period, that could also get you denied. All right, so looking at your 3 months business bank statements, pull this up on my end. So you can see that the beginning balance is 9,000, customer deposit is 16,820. All the withdrawals, okay, cool, right? This person had about $16,000 and $17,000 a month in deposits from that thing left as a balance. Pretty normal scenario. And then all of a sudden, you see that the beginning balance from the carrying over here, the customer deposits, $25,000 in regular revenue. But all of a sudden, you see this other deposits for $57,000. So the total could be pretty substantial about the business deposits there, right? If you look at from the surface, it may look like it's income, but it's not. You can see he or she had this deposit from some merchant cash advancement, the 28,000, another one from Fundbox. 2 companies you want to stay away from as far as possible. I hate merchant cash advancements. I'll explain that a little bit later on. But then in the very end, right? The 60,000 carries over here. Other customer deposits, so 30,000, 40,000. And in this case, he actually used the merchant cash to increase his revenue from that. But again, you're gonna have your UCCs, you're gonna have these high interest, 20, 30, 50, 100% interest rates for these type of loans. But a prime example of the devil's in the details over here, right? All right, so here's one of my funding strategies for you guys. This is something that I got. I got approved for over $100,000 with PNC, and at the time, I was working with my banker. They wanted my business, and I already knew that their max credit exposure for unsecured was 100,000. So I said, okay, I'll move my banking over, and I had some cash at a deposit over there. Then I had a little bit of flow of my revenue from my Stripe account going through that. So it had a little bit of consistent, cash flow. I waited about 3 weeks, and I applied for a $75,000 business line, and they gave me an additional 25,000 business credit card. Okay, so this is a strategy that you can use for yourself, where you can move from bank to bank by understanding one, the story, your revenue, who you are, your character, credit, things of that nature. And then you can do this by rinse and repeating. I have no loyalty to these banks. And once I've gotten what I needed from somebody, from this bank, I'm going to move on to the next. Because if I go to 101,000 in PNC, they're going to file a UCC, or they're going to ask for a whole bunch of other documents. So the whole strategy between me getting that 1.3 million has always been about unsecured funding.
Let's make that land, guys. You want $500,000 in funding, you're not getting it from one bank. You want $500,000, you're not getting it from one bank. You're going to get that $500,000 through 5 banks at $100,000 with no UCC filings, so you're never held back, guys. That is the game. Corporate loan, business lines of credit, business loans, all of it, guys. This is available to you. This is the B-locks you want, Samuel, for Amazon. Anybody doing Amazon, these are the B-locks you want.
Business is just a game, guys. It depends on how well you want to play it. And when you understand it, it's fun. It can get real fun. But again, you just have to have that skill set from all that. But look, I mean, corporate banking. I'm working with a client right now that's doing it's a $50 million business. We're getting them about a $4 or $5 million business line of credit for their company. So part of a little of the testament over here of our inside secrets. This is actually from our banker. This is actually what they have internally at the bank, and how we're able to get screenshots of what's going on with the file. You can kind of interesting how the underwriter's notes are, inside, the banks over here, right? Customers are personally $4,000 in open revolving accounts. So these are all little small things that these underwriters look for. But again, when there is a challenge of some degree, and we have our bankers that have access to the underwriters, and we're able to feed the information. And a lot of times when we get denials, I'm actually able to school the underwriter themselves about seeing a different perspective to overturn it. And a lot of you guys, how many of you guys that have been with me before, have gotten funded, as you understand my processor Hannah, and how she's been able to overturn those denials for us. Hence why I always teach you guys, know the rules of the game, understand your 4 pillars, optimize them, getting at the best foot forward, right? It's all about the prep and the optimization, guys. This is one of the most key elements that I can see and that can teach you. And going back tonight is know the rules of every single bank. I know it might be daunting and so much information to regurgitate and going from there, but create your funding plan, know the rules, and be able to execute based upon your strengths. And as we all know, building credit is a journey. It's not an event, right? The more time that we have to work towards our credit profile, the stronger it is. Sometimes we can go on sprints, but we're in here for the marathon, right? So again, coming back to some of the foundations over here, the perfect credit formula is what I love teaching on majority of all of my clients. Again, there's 4 different types of an account. This is how you can get to an 800 credit score. And there's a reason why I'm explaining this right now, and I'll get to that here very shortly. But there's 4 different types of accounts. You have your mortgage, revolving, installment, auto loans, having that mixture of credits. Again, the age of accounts has a big factor as well. So the longer of establishments, the better, the higher the score is going to go up. So a recent element from actual FICO themselves, they can see a graph of having the number of months of your revolving accounts open and how it affects the risk factor of how a bank's going to look at you. So you only have, a few accounts and it's less than 2 years. You can see it. They're taking a bigger risk on lending you money. So the longer of attachment, you can see after the 120 months, you're at a low stage there. So remember the beginning sequence, what I told you, build up your personal credit, move the inquiries, then build business credit. Once you've let your personal credit rest, then you can go and double dip on the business side, on the personal, and then go back to business. You're always going personal, business. You never stop, right? This is something that you never want to stop on. You're just playing a bigger game every single time. Biggest factor here is your credit utilization, no more than 30%, right? You have a $10,000 limit, no more than $3,000 balance. Payment history is one of the biggest factors of your scores fluctuating. Avoid lates, collection, charge-offs. Stay on for 7 to 10 years. Inquiries, no more than 6 per 6 months. But if you're in a funding stage, you definitely can't have more than 4, right? Some banks have a little more flexibility, but 4 is kind of the magic number of max. 4 or 5. Can they hurt your credit? Yes, absolutely. I just went for a $100,000 business credit card with Chase, and I applied with 2 of my company. I have 3 corps altogether. I applied for 100,000 for one and 50,000 for another. And unfortunately, the banker made the mistake in the very beginning of applying for the wrong card. And we caught that within the first like 10, 15 minutes, but the DocuSign still went through. So I got my first inquiry, all right, minus 2 points. 2-3 days later, another inquiry popped up, both on Experian and TransUnion. My score dropped 8 points, additional 8 points from that, so total 10. And then about 2-3 weeks later, the third one went through and another 8 points got dropped. So I lost a total of about 16, 18 points from those 3 inquiries from Chase. And of course, we're going to be able to remove them. But again, just to tell you that they can have an impact, especially in a shorter period of time. So the number of inquiries, right? If you do have a thicker file, meaning you have trade lines, they've been established, they don't have as much of an impact as if you have a thin file, which is, let's just say, oops, what just happened there? Bad fingers, huh? So the number of inquiries, you can see a thin file versus a thick on the difference in how that correlates together. So again, no more, you should have a minimum about 3 to 5 revolving accounts. Of course, the higher the limit you have, the more capital or approvals you're going to be able to get. So typically a range anywhere from 3 to 7,000. If you're at a 5,000, the highest limit, 20,000 highest limit is going to be 18 to 25. And again, the story that we can always fluctuate and do this. I'm going to show you an example of that later on. Your installment unsecured, right? 1 and 2 installment loans, right? This is your cash loans that you're able to deposit into your bank account. Why does that have so much more of a higher impact on your score? Because you're handling a higher risk amount of capital. So having your unsecured family, which is honestly very important if you're playing the unsecured game with business credit, versus your secured family of your autos and your mortgages, right? You don't pay for your house or your car, they repo it, they foreclose it. But with unsecured, the worst they can do is what? Put it on your credit report and ruin it. They can't come after you majority of the time, right? Unless you get sued. So the age of your accounts makes a huge difference, right? Everything in finance is a law of 2. 2 years of history, 2 years of tax returns, 2 minimum trade lines, 2, right? And it follows you in so many different ways. You always want to know 2 years ahead of what you want to do with your strategies. I brought this one back. I thought it was important. There's a lot of new people in the crowd. Not all credit is, makes it better, right? Essentially, you want to stay away from, of course, the credit ones, the Indigos, Premier First, even some of the fintech ones. And again, the whole theory behind this is that what type of person, character are you, right? If I'm going for a $500,000 business loan, and the underwriter is going to be looking at my personal credit, and looking at the character, what kind of person I am. If I have a whole bunch of, Gap, credit ones, right? It doesn't really show that I'm actually a very strong borrower, right? But if I have the Wells Fargo's, the Bank of America's, and the Chases, tier one, and then tier two, so I would try to stay in the tier one and tier two family as much as possible. Right? It's okay to have some credit unions in there.
Guys, your credit resume is everything. Your credit profile is everything. Is that right, Anthony?
100%.
I need you guys to humanize credit. Date them before you marry them, but I need you to look at your credit resume like your sex life. How many skanks do you really want to be with? Okay. Credit one's a skank. Indigo's a skank. How many skanks do you really want to be with? Do you want STDs? You want AIDS? You want herpes? That's what you guys are doing with your credit profile when you're focused on the wrong shit. Focus on quality. Focus on building out a proper profile. Focus on getting high limits, right? Focus on that. You don't want credit chlamydia. That's right, Lewis. You don't want credit chlamydia. Okay. So stay away from these fintechs and these things that don't add real value to your profile. I'm being funny here just because I'm trying to bring a little humor in here to lighten up the mode or the mood. But guys, that's really what it's about. Building out high level accounts with high limits is called comparable credit. Your credit profile is your resume. Your score is your reputation. Write that down. Score is your reputation. Credit profile is your resume. Okay. That is it. This is simple. Credit is simple. You have to protect your credit profile at all costs. I don't care what these people tell you. There's no PG bullshit. That's not real. Okay. You need to protect your credit at all costs because you will be using your credit to co-sign on behalf of your business. The IRS looks at your business as its own entity. You are an entity. Your business is an entity. You are controlling the entity of your business, right? Own nothing, control everything. Okay. So in this situation, you want to be taking your time, building it out right. What you don't know will cost you. Ignorance will cost you. If ignorance is cost you, put me in the chat. If ignorance is cost you, put me in the chat. How expensive is ignorance? How expensive is ignorance? What you don't know costs you a lot of money. That's why you guys are in the room. That's why the best thing you can ever invest in yourself is good soil. Not bad soil, good soil. Listen, bro, if I plant an apple tree in Antarctica, it's not good soil. It's not going to grow.
Right.
Right. But if I plant an apple tree in the fields of Ohio, notice I didn't say Michigan, in the fields of Ohio, then it's going to grow better than it's going to grow in Michigan. Okay. So the bottom line is you need to be investing in groups, in people, in programs or experiences or live events that's going to take you to the next level. Things that people can never take from you. Once you earn and learn something, nobody can take that information from you. You can go bankrupt, you can start a business because you are a collection of your decisions, your thoughts, your habits, right? You are where you're at because of your decisions, both good and bad. So understand that ignorance isn't an excuse and ignorance will cost you more. How do you want to pay for it? Do you want to pay for it with time? Do you want to pay for mistakes, heartache, pain? Which way do you want to pay? Which credit card? Ignorance? Or do you want to pay to play and get ahead of the game?
It's so true. Everything that you're saying though, Dan, 100%. All right. Shortcuts to strengthen your credit. So if you do have that, initial, credit card, or you have a whole bunch of them, again, every 1, 3, 6 months, you want to call your credit card company and ask for credit limit increases, right? I'm not going to go in depth of it right now, but again, always have a good story about how your business is growing. You're about to go into a Facebook campaign. You need the capital from their bank. You want to establish a strong relationship with them. You have a relationship manager, right? Use all of these different tools, right? Every bank's a little bit different, but ask for those credit limit increases. Put it on your calendar, right? Because you're 5,000 to 10,000 to 20,000 to 100,000, like all of these things can be a big influence on your personal credit to then further on strengthen the business credit once you're ready for that, right? It's a little script you can go through later on. Manipulate the algorithm, right? If you're able to pay, max out your credit cards and pay it off, max it out, pay it off. Naturally, of course, American Express is notorious for this, of increasing your lines quickly by understanding that demonstrating you're a high net worth individual and that you need the capital to be able to move forward, from that. So keep on doing like a band-aid effect. Personal lines of credits, right? Because that's in the revolving family. A little bit of the hack I love to teach my clients. If you have a $5,000 limit, that's your average, and it's look, I don't want to have to wait, years to be able to get my credit limit all the way from 5, 10, 15, 20, etc. If you're able to qualify for a $25, $50, $100,000 personal line of credit, then that's unsecured and it's in the revolving family. What do you think is going to happen when you're applying for new credit, once you let that season for a little bit, that these new credit cards are now they're going to have to match you for your highest comparable credit. So very similar to qualifications as a personal loan, you're going to look at your debt to income ratio and your credit, and start applying for that. Have one or two. Again, in that cool off phase, you're going to be able to get one of these and plus some unsecured loans if needed. A little bit of a bonus trip here. If certain banks can extend your promo rates, so you just have to ask. I have one of my Discover credit cards, and of course I've had that for 6-7 years. And I call them up and like, hey, you have any promos? And they're like, hey, we can reduce your overall 22% interest rate down by like permanently by 2% with the margins. Or you can have another 0% for another 12 months. I'm like, give me the 0%. So who here knows their credit utilization? Speaking of the devil there, my friends, do you know what your current overall utilization is, or your individual? So is it over or under 30%?
And the sweet spot is really like a 7%. That's the thing. People think 30 or under 30, guys. You really want to be in that 7 to 10 range, at least under 30 for funding. But shoot, the optimal is what, the 7 to 10 range. I think. What do you think?
Does anybody know what the ideal, how FICO rewards you for the most amount of your credit utilization? 7%.
That's what I said, Dennis. I said 7%.
Yeah. How'd you come up with 7%?
Oh, 7's the lucky number. Every time I play, every time I play in Vegas, I always hit the 7s. Me and Armin, man, we always hit jackpot.
Sean got it. 1 to 6%.
100%.
Yeah, so it's straight from FICO, right? I actually have their internal documents, and they have a point system, not credit scores, but a point system, and 1 to 6% of utilization is where they reward you the most. And if you pay it off at 0, you don't get the same reward or the credit score increase as if it was at 1%. Interesting enough. I don't understand the logic, but that's how they made it. So 1 to 6% is that great. All right, so I wanted to bring this to attention because I know overcoming high credit utilization is a big deal, and it's definitely one of the challenges that we face, on a daily basis, especially right now, where a recent study from Bankrate said that credit card balances are at 40% higher than they were in 2021. Where about 56 million people currently carry credit card debt that's more than a year. And even the clients that I was dealing with, even in the RAD community, right, there was one of the challenges that we had to overcome was high credit usage. And as you all know, if you are maxed out for a long period of time and you start paying it down, have any of you guys here felt the pain of them slashing your limits? Has that happened to you where you've had a long maxed out credit card, let's just say for 6 months or a year or some sort, and all of a sudden you pay it down and they just went and they slashed it? Put a yes in the chat if that's you or me. It's crazy. So making sure that we have the right strategies of paying down and doing this, it's a little bit of the 10 different ways of what I have developed throughout my journey being in this game of credit optimization. But as you can see here, where the 0 to 19% is a little bit of the risk factor, and as you're going all over 100%, right, very self-explanatory there. But looking at leveraging all the different tools and the strategy what you have access to right now of what you can do to decrease that dramatically here. Okay, number one is shifting it to your business credit cards. So if you have an existing business credit and you're able to take your personal credit cards and then do a balance transfer or liquidate and move over to the business side, that will help you with your utilization. Again, by having good credit, you can always sign up with a new LLC, or you could establish a new one or tap into the existing one as long as your personal credit is clean. You want to preserve that as much as possible. And the number one thing that's important, of course, and here in America. So shifting it from personal to business. Another business strategy that I've developed here is merchant cash advancements. Now, I passionately hate MCAs. I actually get people out of those type of loans. However, they do serve a purpose. It's more of your bridge loan aspect of it, where you have a use for either 1 to 2, 3 months to be able to resolve and solve a current problem, and then you're able to pay them off thereafter. So how I use them is that, number one, there's certain companies like like Fundbox or some of these other ones, these MCAs that don't file a UCC. So remember, you want to remove all UCCs as much as possible. If your credit isn't the greatest because of high credit usage or whatever, you want to get an MCA, take that capital, pay down your personal credit, as long as it's the only thing that's stopping you from getting approved. And that way your credit score is optimized. You now then can go get good debt, pay off that MCA immediately after. Okay, does that understand? It's like a 1, 2, 3 step in this way. A UCC is a lien that gets placed on your business credit, letting the world know that, hey, I lent this person some, it could be a capital, a loan, or anything of that nature, that letting them know that you have a debt. There's certain ones like equipment loans that are not really detrimental for you. But if you have, if you have your EIDL, they're going to file a UCC, which, that's actually good debt, very, very long term. But any of these MCAs, majority of them will file a UCC, letting the world know that. All right, balance transfers or liquidate. So if you have room on your business credit cards, you want to liquefy it, and then you go and you pay down your personal credit. A little bit of that strategy there. All right, using your personal credit, right, is what I like to call the shift to debt, where you're able to change it from revolving to installment. Again, I try to avoid playing with the personal credit version of it, but again, the outcome is more important than in this situation. So if you have a whole bunch of credit cards that are maxed out and you need to consolidate that or qualify for a personal loan to then pay off the revolving debt, that could be one strategy that you use. Using your personal loans at the same time. Again, it's very similar to the two over here. Balance transfers between each accounts. So if you have a high limit credit card and this other one that is lower but is maxed out, you can do a balance transfer. I'm going to show you an example of what I mean by that. You can always ask for credit limit increases, but again, the best time to ask for increases is when your credit score is as high as possible. The best time to ask for money is when you don't need it, right? But again,
100%. 100%.
These are the things that are going to help chip at the challenge and get you closer to that outcome. All right, so shifting a debt, you can see that if you have on the left, you have a maxed out credit card for $10,000, you have another one for $5,000, another one for $2,000, right? And they're all $10,000 limits. And so if you shift it and you do a balance transfer between the two, you're 34% versus 100% and 50%. Right? You're not spending any money. You're just really shifting it. And that looks a lot more stronger. Your credit scores will increase without spending any money. And this will actually be in the borderline where you can still get new approvals by doing that. Does that make sense?
Mm-hmm. What's funny too, Anthony, go back for a second. How many Americans see all of you guys in the room, you guys are overachievers. You understand this, but most Americans would see this right here. This would be average for people that have a $10,000 credit card and they don't understand why their credit score goes down or doesn't go up when they pay their bill every time. It's because they have a 34% utilization across the board. right? And that's what you don't know hurts you. So the normal American would see this, say, hey, I have a $10,000 credit card. That's all I need. They're gonna say that's all I need. I don't spend more than $10,000. No, grandma, I get that you don't spend more than $10,000, but when you spend $3,400, your credit score will go up by you just having access to 20,000. You don't need to use the 20,000. Remember, what you don't know is hurting you. So in this situation, this looks like a lot of Americans today, Anthony, working a job they can't stand, getting credit cards to pay the bills. Most people look at credit as a bad thing, not as a way to get rich. This entire monetary system is built off debt. Every good real estate investor understands, give me as much debt as I can have because I will write off everything. I won't be making money because I'm in debt. Meanwhile, I'm controlling assets and getting more capital and credit off these assets, and I'm becoming uber super rich. When you understand how the monetary system properly works and you know how to leverage credit to build wealth, my God. But this situation right here is a nightmare situation for most Americans. They don't know how to get the credit limit increases. They don't know how to shift the debt. They don't know when to pay their bill. And they don't know the ramifications of paying their bill on this date versus that date. This is just, you don't know what you don't know. You guys are all in the room, so you understand that. But guys, that is key. Shifting money, shifting debt, taking this debt, moving it onto ghost lines, which we'll talk about later on, lines that don't report to business or personal. Well, why would I want that, Dan? So you could hide the debt so your score can go up. And that's the biggest reason why credit repair companies is the biggest scam, is because they tell people don't apply for new credit, right? Well, you need to be having positive payment history every single month. It's what you don't know. That payment history is big. That utilization is big. The inquiry itself is not big. The new account itself is not big. That is just a small sliver of the pie compared to what really matters, right? But this, Anthony, this right here is most Americans with a Chase card, with a Discover card, and they don't want more credit cards, but they don't understand how much this would actually matter if they had them.
It's actually one of the number one challenges that we face that we have to overcome in our business, right? From the hundreds of clients that we take on and we're reviewing, the credit utilization is actually a pretty big deal, right? And so hence why I did extensive amounts of research on how to fix these type of situations. I'm going to provide you some additional ones real quick as well. Now, adding authorized users, it's not going to help with the credit utilization, but again, it will increase your credit score. And you have two different options. If you have friends and family, if they've been responsible, looking at the perfect credit formula, right? If you understand that concept, everyone can increase your score 5 to 30 points. And that's enough points for you to be able to get a personal loan. And that can then help you qualify to pay off the revolving debt or shifting it for another business credit card if they have lower requirements. Those are all certain things, right? So you just have to chip away depending on where am I at, what can I do right now, and what can I control to be able to solve this outcome, this problem a little faster. So asset-based lending, if you do own a home, I recommend getting a home equity line of credit. It's not something that I do. I used to be in the mortgage for about 10 years. But again, having a HELOC, which is secured debt, it's easier to qualify if your debt to income ratio is in line, typically around 35 to 40%. But having that, as far as the qualifications, that can help reduce and get that outcome a lot faster. Doing a cash out auto loan, where if you have a paid off car, let's just say it's a $10,000, $20,000 vehicle, that's what it's worth, and the bank's going to give you 50%, 60%, 70% of the value of that in a cash out refi, then use that and pay off your personal credit debt. Once it's paid off, going as a business credit, and then you're off to the races. You can use a lot of these new technologies, fintech HELOCs are coming out. Avon is one, and Figure is another one. I haven't worked with them personally, but again, if there's a
People
way,
have gotten big approvals with Avon in here, brother. I have people that signed up for the program the same day that I talked about Avon a couple months ago. They got a home equity line of credit like that, guys. Definitely tap into Avon and tap into Figure for sure. Big deal right there.
Again, yeah, having them available. Again, I don't know how they would compare to a traditional, but again, that's a whole different conversation, different day. But hey, if it's going to be a quick approval with less headache, not have to wait 30 days, and I can fix my personal credit a lot faster, and game on. All right. So here's when we get a little creative. Borrowing from friends and family. So if you understand, I'm actually going to put these two together right now. So borrowing from friends and family, and if you know that you have an exit, and a credit partner is very similar to the same point. So a credit partner is that either a co-signer or a credit partner that can be the person who can qualify either for your business or or personal. Again, what we can do with one person, we can do with others. So let me give you an example. Let's just say that your business is like a car, and you are currently the driver. And if you're currently maxed out, your credit's not the greatest, all we're doing in this credit partner strategy is moving you from the primary driver to the passenger and having your credit partner be in place. Now, that person with great credit can go and apply for a business credit card, 0%, etc. And you take that capital, that the new capital that person was able to qualify for, then you're able to do the whole existing business credit card transfer play, fix your credits, get your utilization where it needs to be. Now your scores shoot up to the 700s, etc., because of high credit usage. Then now you can then go and get qualified for your own business credit, business lines, term loans, whatever you can. And then you take that money, you pay off your credit partner, and you thank them and have a nice day, whatever reward or what incentive that they're going to be risking from them. Now, again, I only use this strategy, number one, if they fully understand what the risks are, because they are going to be the one guaranteeing the loans. But again, the biggest thing is that what's my exit? What's the exit for the credit partner? If I just need that person for 1 month, 2 months, then that friend or family, mom, dad, sister, brother, cousin, business partner might be a good solution to help you get there. Again, it's just in the story that you craft. But again, I've used that many times and it's worked very well. We do have access to a private bridge lender. It's not the cheapest option. Okay, it's literally it's pretty crazy for what they charge. But again, if that was if the only thing that's stopping you from getting your new loan and you're working through us, let's just say with us, they will charge you 20 to 30% of what they lend you. But they're taking a huge risk by paying off your credit cards and hoping that you don't go and spend it, right? Go to Toys R Us and buy some toys that even still exist these days. But that is an option that does exist out there. So if that's the only reason why you can't get approved and none of the other options work, then that might be a solution for you. Have you guys ever heard of this company? Goss? Anybody here? This is actually what you're talking about earlier on here as a ghost debt.
Mm-hmm.
So the interesting thing about, I have actually aligned with them as well, but they capped their interest rate at 16%. It doesn't report anywhere. It's no credit inquiry. And what they do, they connect their account, their platform with Plaid, and you want to connect as many accounts you have. You have your business, personal, whatever you have, to connect your data points. They're going to look at your cash flow, and they're going to be able to look at anywhere from, I think, 10 to 25,000 is what they'll approve you for. And it's only meant to consolidate out your high interest rate credit cards.
It's a gem, guys. That's a gem.
Yeah, I believe you need to have, if I'm not mistaken, maybe like a 660 or 670 credit score. They're not in all the states, but they were in a lot of them. So download the app and see if it's in your state. But having this, I think everybody should have this.
Mm-hmm.
It's like a credit line. Whenever you need it, you just tap into it. They pay off. It takes about 3-4 days. They pay off your credit, and it's ghost. Nobody knows about it. So it's perfect. Every single person here should do this right now. I just want to also say this though, like this week right now is more about building the foundation, the strategies, and the plays. Where I'm going to dive into a little more of a lot of advanced elements is going to provide even more value than what I'm giving you right now. So hopefully you guys are getting a lot out of this. Again, or if you are, hopefully that's amazing for you. All right, so put everything on auto pay, avoid that 7 years of misery, avoid interest, either paying, well, we already went through this, paying full, or leaving a balance, the 1 to 6%, build age, stay active. If you have credit cards that you haven't been using for more than 6 to 8 months, they'll turn into an inactive stage. Go and pay for some groceries, make it inactive so they don't shut down. So when it says on your credit report, closed by grantor because you haven't been using it. Now there's leverage date, meaning that you want to monitor your closing statement dates on your credit report. All right, what do I mean by that? Is your payment due dates is typically, let's just say on the first, your closing statement dates to 2-3 days after. That's the date that the balance gets reported to the credit bureaus. So what I've done for myself is that I've actually now I've changed to 3 different dates on the 1st, the 15th, and I have one on the 25th. You can change your payment due dates for every single one of your credit cards. Instead of having to go, oh, I got like 15 cards, one's on the 1st, one's on the 3rd, one's on the 16th. Just consolidate it out. Number one, put it on auto pay, but change it to like 1 to 2 to 3 different times a month. So on the 1st, I pay my cards down on the 30th or the 31st, and I use the ones on the 15th. You just kind of, I'm playing with my money because of the closing statement dates. Okay, does that make sense? And part of the whole challenge is of number one, hey, if I need to get to the outcome faster, right? Let's just say you did your credit utilization, you have all those different hacks that I just showed you. We just introduced this the rapid rescore, which I can force update your credit report in 24 hours. So if you just missed that whole closing statement date, let's just say what's today, the 16th, and you just like, oh shoot, I forgot to pay that one card down. I was maxed out on the 15th. You now have to wait 30 days for that to update because I can't go in with a maxed out credit card. So we use these tools to be able to get to the outcome faster, right? And so it's a little bit of a tool that we use to be able to do that. Sorry, I thought you were going to say something there, Dan.
No, I'm letting you go crazy.
The more tools we have, the faster we're going to get there, right? No matter what it is. All right, so here's a little bit of the last element here for overcoming personal credit challenges. When I look at the problem, I say, look, what is my solution? What resources do I have? What strategies can I implement? Right, derogatories, you go through the credit partner route, like the interim CFO, the whole car analogy I mentioned to you. Or you have to go through credit compliance or credit repair, one way or another. I used to have horrible credit because of what happened to me a long time ago. I had to rebuild myself. Somebody did remove a lot of things for me. So I know there's some things that do work. But again, if you're doing the monthly subscription bullshit, that shit doesn't work, right? What incentive do they have to pay to get rid of your stuff quickly if they're paying a monthly subscription? I have a guy that I use that is more for collections and charge-offs. He's able to get results in a matter of weeks. Anywhere from 2 to 8 weeks is what I like to do. So I only use him because I know he's about a 95% success rate, for us. So high credit utilization, we just went through that. The FICO boost, you add in trade lines. So again, in the world of personal credit, all of these different challenges that we face, I say, how do I help and fix this quickly? What are the solutions to be able to get there faster? Because yes, I would make actually a lot more money if I just handled clients that were just a 700, 800 plus. I wouldn't have to work with the whole thing. But again, I went through that bullshit myself. Therefore, I want to make sure that I help my clients because I understand what you have to go through to be able to get there. All right, moving forward, crafting a solid story for our bankers. Yeah, as I mentioned before, this is where this one client had a recent 30-day late, literally about 3-4 months before I was actually working with them, and he only had a $4,000 city limit. That was one account, one credit card, $4,000. And if I knew that I was going to apply for an online submission, that he would get denied, definitely. So again, I asked him, no, give me the full picture, give me all your documents. So we looked at him, look, he actually has some cash flow, he has some money sitting in the bank statements. So I said, look, all right, if you have the cash sitting in the bank, you have some, you have a successful business. What can I emphasize on, right? Looking at the strengths, I came up with a story that, hey, the bookkeeper messed up. It wasn't a habitual scenario, and that he's now a growing company. So again, looking at the full picture, you can then craft, okay, what do I want to tell this underwriter to be able to get this person approved for this loan? But I can't go in looking like this, right? High credit usage. You can see a 694, $20,000, 55% total. You had that late that just happened. You can see right there on 2-3 months of us, working at that time. Optimizes credits, 12% utilization. I look at the bank statements. I worked with my Chase banker, provided the story. Here's some additional proof. And boom, $35,000 approved, for him. And as we know, your highest revolving limit on your personal credit kind of dictates where you're going to get. Well, this is how I was able to 7x that limit for him. All right, moving forward. So what is corporate loan stacking, right? Loan stacking refers to the practice of getting multiple approvals between different lines, credit cards, B-locks, loans, term loans, whatever that is, right? And so that's the art of it, but I like to be able to stick to the unsecured family, as I mentioned before. So this is what I go through in my own process, but I wanted to ask yourself the same question. So when I look at, hey, what are all the questions that I need to ask my clients on every single category of the 4 pillars, and really craft the whole entire process of, okay, start to finish, what are they looking for? What are strengths and weaknesses? So number 1, how much money do you need? Use your funds. Is it going to help my business grow? How fast do you need it? How much business credit experience do you have? What type of loans do you need? Do you need an equipment loan because you're in trucking or manufacturing? You shouldn't get a cash loan if you need equipment, from that. But you still need working capital. Then you also want to take advantage of some business credit cards for the rewards, travel, things of that nature. Or you have a whole bunch of account receivables, which maybe I get an account receivable factoring line or a business line of credit for that. So that whole story about what do I need in the very beginning is very key. And then I want to dive into the personal credit. So is your credit score less than 700? Do you have a thin file or a thick file? Or is your age of your total accounts less than 2 years or more than 2 years? Your utilization over 30%? Do you have any late collection charge-offs? 4 inquiries in the last 6 months? So if any of these of this formula is out of the balance of what these banks look for, what do you have to do? Do I have to add some accounts some authorized users? Do I have to start building up personal primary accounts? Do I have to do an inquiry wipe? Do I have to use all my 10 strategies of the utilization? For every single person, we customize and we say, what do we have to do for that? But I want you to understand this framework for how to think like a banker. And these are the same criteria that they look for yourself. All right, do you have business credit? Do you have established with all the big bureaus? Is your business credit utilization above 30%?
Talk about this, bro. This is saucy because a lot of people don't realize that there's a such thing as a business credit utilization, how to fix it, how to see it. Go crazy on this slide, guys. You guys ready for this one? This is going to be a good one.
So one of the first things we ask from you is what's your business debt schedule, which a lot of banks will ask for. So give us everything. Give me the good, the bad, and the ugly. I want to know everything because of the fact that, hey, if you have maxed out credit cards, and even though they're not going to report on your personal credit, but they can report on your business credit. Does this one credit card, does it report to Experian business or Equifax business or Duns and Bradstreet or SBFE? So if I know that, hey, I'm going to help you get funded, but you have 5 credit cards that are fully maxed out, and all of those are reporting to Experian. Let's just say. And the next time I want to apply for a new account for you, that one particular bank, is it PNC, is it Chase, is it Citizens Bank, BMO? Which business credit bureau are they going to pull? Are they going to see that those 5 maxed out credit cards are going to be on Experian? So what am I going to do there? I'm not going to go to Experian from that one bank. I'm going to probably go to Equifax. Maybe that's not reporting on Equifax. or maybe they're not reporting on Dun& Bradstreet. That's the complexity that we have to go through of finding out what are the strengths and the weaknesses. What can I shed the strengths on? Is there a story that I have to be able to bring on? But having visibility on the full picture, even business credit, can make or break a denial. You want to use your inquiries wisely, because everyone can be worth 10,000 or 100,000. You choose. You only have so many shots, so many ammunition that you can do within 6 months. There's only so many inquiry wipes that you can do at the same point, guys. Right? When you go and call it in, or you use one of these, even my company, you can't do an inquiry wipe every 2 weeks. You have to let your credit breathe a little bit, man. It doesn't work like that.
100%.
So over leveraged, right? Is there UCCs, public records, tax liens? Do you have late payments reporting on your credit, on your business credit? Even those vendor credits, or Dun & Bradstreet vendor credit, your U lines, etc. If you forget to pay one of those and that reports on your business credit. I had a client that had the perfect situation: personal credit, business credit, strong financials, 2 years in business, etc. But they just recently had a vendor credit in the construction business that had 30, 60 days. And it was difficult for them to get approved because it was so fresh. I shed that light, not because of that, because there's different ways. If one avenue doesn't work, we have to go another one, and another one, another one. We've actually done, even for some of our clients over here, even in the Radic group, we've done as much as 20, 25 applications with somebody, because we had to work, because there was a challenging file, high credit usage, right? Business credit was maxed out. But again, we want to try to make sure that we help and get you to that outcome faster. Hopefully this makes sense when you shed some light on what we have to go to. But even if you don't work with us, which is okay, but these are certain questions you need to ask yourself.
Yep.
And so look at this whole entire matrix and say, what part of this do I need to work on? Or if I'm going to take a chance, will that work with Citizens, PNC, B of A, regions? That's where it gets a little complex here. Same thing with corporate compliance. I know you guys have gone through this, and extensive. Is your business less than 2 years or more than 2 years? Is it an H corp? There's great things about H corps, but there's also a lot of bad things. And I think if you buy from a shitty source, that could really screw you with the tax liens and all that kind of stuff. I'm not going to get into that right now, but again, there's a different structure and how we have to go through the setup with an H corp versus if it was actually something that it was born from inception. Are you a sole prop or LLC or a corp, right? Are you low or high risk? What state are you in? There's certain states that are great for funding, like Florida, California, Nevada, Texas. And there's certain ones that don't have a lot of exposure. So can we foreign file? Are you foreign filed anywhere? If you're like Dennis and wants to foreign file to 20 different states, then great. It might be a lot more options, but it could be pretty expensive. Can you afford that, right? All of these small little things. Your online presence, your business address. Is it a virtual address? And a lot of times, even a virtual address, you want to be careful, because some of these banks say that I think it was one of my clients that had a Wyoming corp, and their virtual address was actually was blanketed between an office that had a lot of fraud attached to it. And they denied us because that address was associated with other people who had fraud, right? It's just like little small stupid things that can really screw things up. Your financial review. Do you have cash flow, right? Do you have strong bank statements? Are there any deposits, loan disbursements, non-sufficient funds? What's your gross revenue? What's your net profit? Are you leaving any net profits in your business on personal bank statements, etc.? What's your net income, your adjusted gross income? These are all the different little things that we have to go through as I underwrite and look at things. Are you in growth mode, or are you just getting by? If I don't get you that loan, is your whole business and world going to collapse? Or you're growing so fast that you can't keep up with demand? So two different strategies in how we have to implement, right? Then after we've done all that with the whole 4 pillars, then I say, okay, well, who of the 500 banks that we probably have more right now, but even those 500 banks that we have access to, Who's going to be the best fit? Does your does your state have the streamlined programs? Do I have to go full doc, light doc, no doc? How many banks do I need to apply with and get you approved to help you with your funding goal? Are some stricter than others? What type of business loan do you need? Right? Do you see so these are all certain things you should ask yourself, and being able to put that whole funding plan in place. Then you get your approvals or denials. Can I overturn it? What additional documents are they needing? What was the cause of the denial? Can I fix that? Can I come up with a good story? Can I provide some additional supporting docs to get that? Did we get the loan amount, or do I need to push for an increase? Or do I need to fight for the limit cut, right? Because they reduce it for whatever reasons. Now imagine doing this 100 times a month while studying the economic forecast of our economy and the banking requirements and sentiments. And hopefully nothing changes. And every 3 to 6, 12 months, things change, right? Like Truist had their no doc program for up to 50,000. And now because it went all viral on YouTube, now they're asking for 4506s. Right? That changes the game a little bit. A lot of these people. You put it all together, kind of looks like
when you do it properly, guys.